Hello, this is Chuck Carnavan. I'm the Chuck in the Markets Up Chuck, and we're going to continue with our retail theme for this week and take a look at Kohl's, which reported earnings this morning, as well as Wal-Mart, which reported earnings yesterday. And I want you to look at this stock. This is a pretty good retailer. I want you to notice that since 1996, their earnings growth has been pretty consistent. They had a drop in earnings in 2003 and 2004. Then they followed that with some good rallies, flattened out a little bit. Had a drop in earnings during the recession, which of course was last year. Now earnings seem to be back on track again. Now what was interesting is Kohl's reported a 21% increase in earnings versus the third quarter of last year. But keep in mind, the third quarter of last year showed was in this down trough, and in the third quarter of this year is showing an upcycle in their earnings. So they had a 21% increase, which is terrific, but it was off the low base. But that's really not what's important. What's important is the long-term trend of earnings growth. Now, when you look at the stock price, the monthly closing stock price, I want you to notice that for this period here, that the first 6-7 years, Kohl's stock price was actually very overvalued. Of course, their earnings growth, if you look at the numbers on an annual basis, 25% growth, 34% growth, 41% growth. So these numbers were probably more justified than this chart looks like, because obviously their earnings have slowed down in more recent times, which is understandable when you consider two recessions that we've gone through, 2001 and then of course 2008. But the point I want to make is, when the earnings fell, the stock price came back to a more rational level. Then it rallied again. Then of course the recession came and the stock price really collapsed. But look how quickly it's recovered as their business continues to improve. Now, what I also want to look at is, they had a 21% increase in growth. They've averaged 18.6% over 15 years. But look what happens if we just look at the last 5 years for Kohl's. What you see is because of the recession, their earnings growth has only been about 7%. So, that's not that bad when you can all things considered, but it is beginning to increase. The 21% increase in the third quarter is hopefully a precursor of things to come. The forecast for this company going forward by the leading analysts is about 14.5% to 15%, which would imply that Kohl's is probably maybe modestly overvalued to reasonably priced today. But the point I want to make here is that the idea of a lesson in valuation is that earnings do determine market prices. You can see by the longer term chart. And then more importantly, when stocks get mispriced or get overvalued, that's the time when they'll normally revert to the mean and come back into valuation. That happens when they're overpriced, also happens when they're underpriced. But the idea that whether they beat expectations or not, to me, is just a lot of mumbo-jumbo, just a lot of short-term hype. What really matters is what the long-term, benefit of the company, what the long-term growth rate of the company, really, amounts to. When you look at Wal-Mart, you see another interesting picture here. Their growth rate, Wal-Mart's growth rate for the last 6 years has been a consistent 8%. If I go back to the 15-year chart like I showed you on Kohl's, you'll notice that Wal-Mart, for the behemoth that it is, $204 billion market cap, actually averaged 13% growth. But again, you got your lesson in valuation. There was a period where Walmart's stock price got irrationally exuberant, and you had 7 or 8 years of very poor performance, even though the company's business did well. Eventually, the stock price reverted to the mean. But the real key is Wal-Mart had a much lower earnings report. They only earned or showed about a 3.2% increase for the third quarter of this year, but that was versus, compared to the third quarter of last year, which was kind of a flat year. They only had a 9% growth rate during that year, which was below their historical average. So the point is to have all these things into perspective and to recognize that it's the long run or long range earnings, growth that's going to determine your returns and your market price. Now, Walmart's forecast to grow at 11%, slightly slower than Kohl's, but when you consider the fact that it's a $204 billion market cap, the 11% growth rate for a company of this quality would be very attractive with a 2.1% dividend yield. Kohl's, which is much smaller, only a $16 billion company instead of a $200 billion company, doesn't pay a dividend but is expected to grow faster. So, that's kind of how you want to look at investments and look at companies in terms of when you're making your decisions whether you want to own them or not. It's a matter of determining how much you're interested in growth versus income, or the combination of the two. And this is Chuck Carnavan saying, hope this gave you some additional perspectives in investing, and look forward to talking to you again tomorrow. Thanks for listening.